Dear audience, I come to you today with some enlightening wisdom. No, central banking and paper currency has not enslaved you. You have enslaved yourself. As the Greek philosopher Plato once said in his seminal work, The Republic, it is not the state that corrupts, but rather the citizens that allow it to become corrupt. Okay. So let's get something straight here. Just because there is a central bank, and this bank creates currency to lend out, does not mean that you are enslaved to the bankers. The gold standard, and even silver standard, are not magic bullets to liberating the masses from financial slavery. It is not the printing of money that is the crime here. Rather, it is where that money goes. Where the money goes is determined by politicians, voted into power by you, the citizenry. The advancement of technology and manufacture have made food, transport, and entertainment dirt cheap, and life is easier than ever before. The citizenry currently, largely, do not care about the fiscal policies of the government, while they can still afford Netflix, Uber Eats, lattes, and pornography. Until this changes, no one will care about the implications of government economic policy. I'm not going to stick on economic theory here. I'm going to stick on historic fact. Galbraith says that economics tries to engender an image of mysticism and magic in the eyes of the common man when discussing currency and central banking. I am not going to entertain it to any complexity for this reason. It is more difficult than it should be. This is a chemical engineer's perspective of the historical facts surrounding money and central banking, and I don't have time for hocus-pocus bullshit. I've just spent the last week reading and making notes from various books about the history of money, banking, and how it was created. In that time, I have gone from being a staunch opponent to the printing of paper money and supporter of gold and silver standards to a man very much in support of money printing, when circumstances warrant it. What circumstances, you may ask? Okay, well, I've assembled a list to prove to you that printing of money can be very beneficial. In 1694, the Bank of England took over government finances and printed £1.2 million to build a new navy to fight the Spanish, Dutch, and the Americans, from a fraction of small deposits from founding shareholders. This navy later went on to dominate the high seas from the mid-1700s up until the late 1800s, leading to a period of unparalleled trade and prosperity for Britain. Bank of England notes were more reliable than hard currency and could be redeemed for gold and silver. They maintained their value even during the Napoleonic Wars when the French domination was high and exchange of these notes for hard currency, which was the norm, was temporarily suspended. In 1720, John Law arrived in France. France had been crippled by wars waged by Louis the Great, and most of the coinage had flown overseas to pay for these. The shortage of gold and silver had crippled the French economy. There was no money for which to trade. To fix this, he established a bank that printed and lent paper notes to the government to pay for its expenses, based on fractional reserves of gold and silver. The injection of new currency allowed commerce to restart, and had printing not continued under the false guise of investment in the Mississippi Company and its non-existent Louisiana swamp gold, the Banque Generale would have been a historical success story. In the 1600s and 1700s, when colonial America had a shortage of gold, silver, and British pounds, the mercantilist policies of Britain had meant that gold and silver could flow into Britain, but was difficult to flow out again. Taxes had to be paid in gold, silver, or pounds, and which produced an insouciant drain on currency essential for trade in the colonies. In response, the colonies used various forms of commodities as currencies, most prominently tobacco. Taxes in colonial America were rare. No income tax existed, and tax was largely restricted to trade and export. The middle colonies of Pennsylvania, New York, New Jersey, Delaware, and Maryland all printed limited amounts of fiat paper currency for the government to pay its expenses. Some inflation occurred, but it was manageable, and the introduction of fresh currency provided credit for the rapid agricultural expansion occurring at that time. In 1750, the British Parliament voted to prevent the colonies printing their own money. This caused such distress that Benjamin Franklin went to Parliament in person to protest, but to little avail. The motherland did not want the colonies printing their own money, as this would compete with the Bank of England's notes and increase the colonies' autonomy. The ban had the opposite effect and led to serious tension between England and the colonies. Printing largely continued in the form of smaller state banks. This tension would eventually culminate in the Revolutionary War of 1776, the expenses of which were 90% financed by the printing of so-called continental notes. Heavy inflation occurred, but there was insufficient gold and silver reserves at that time in North America, and no one wanted to pay tax. It was the best alternative. Before the French Revolution in 1790, the state's fiscal affairs were in a dismal state. Louis XVI had allowed prodigal spending. Government war debt payments had been a constant drain on currency. Taxation systems were antiquated, crippling to trade in some regions and non-existent in others. The crash of paper money during the Banque Generale of John Law made the citizenry reluctant to use anything that wasn't gold or silver. Currency shortage had led to agricultural underinvestment, and the population had increased by 40% in the last century. Poor harvests had occurred in the years before the revolution. The farmers didn't have enough food to sell, and the urban citizenry didn't have enough money to buy food. We now enter the assignat, or French Revolution paper money. To raise money for the costs of the revolution and expenses of the new revolutionary assembly, government and church lands were confiscated and used to back the assignat notes. The notes would be redeemable at the end of 5 years for land. With new currency, commerce restarted and the economy began to recover. Had printing stopped after the first issuance, the assignat would have been a successful innovation. But as the revolution drew to a close in 1797, the assignat had lost most of its value from overissuance. Inflation had occurred, but it was far better than the earlier alternative with no money in circulation. The revolution had been successfully funded through the printing of paper and the unfortunate confiscation of church lands. Any listener of decent intelligence at this point will notice one thing. Currency, whether gold coins, notes redeemable for coinage, or even valueless fiat paper, work successfully under one condition, that of scarcity. As long as the currency expands subject to the demands of a growing economy, inflation is manageable or even negligible. Moving over to America, the War of 1812 against Britain suffered from the lack of financial preparation. The charter of the first bank had expired in 1811, and Jefferson and Madison had resisted renewal, thus making it more difficult to obtain loans and finance the war. The reason for the War of 1812 is often debated. Whether the financiers who owned the first bank, many of whom foreign that shared in its profits, angry at the failure to renew, had helped precipitate the war is unclear. Regardless, the federal government was pressed for war funding and decided to suspend gold redemption for all state notes in existence and issue interest-bearing treasury notes and bonds to pay for the war. These would require interest at periodic times and final redemption. The government's ability to finance the war through trade taxation had been halted by trade embargoes. At this time, Britain controlled the seas. Treasury notes issued in 1812 had become due in 1813 and 1814, and with the war still on, there was little revenues to pay interest and redemption of these bonds. In 1815, the government defaulted on the treasury notes it had made. With this default, it became nigh impossible to find credit for the government, and the treasury notes that had served as currency during the war became worthless. In this vacuum of United States currency, hundreds of banks began to spring up in 1814 to facilitate commerce in the post-war demand and boom. Between 1811 and 1816, private banks had sprung up in response to the demand for loans and currency to facilitate the development of the frontier lands, which were rich for agricultural purpose. These banks had varying levels of hard currency reserves, which made some notes worth less than others. The capture of Washington in 1814 by the British had meant all banks had suspended redemption of notes in hard currency, and the private notes in circulation doubled from $45 million in 1812 to $100 million by 1817 to support the post-war boom, with accompanying inflation. The Second Bank of the United States was chartered in 1816 due to the pressing needs of financing the post-war government, and by 1819 forced the hundreds of private banks to raise interest on loans and slow lending. The boom collapsed, but the economic investment enabled by such easy credit remained. But despite all this, America's situation in 1816 was anything but dire. Tremendous amounts of land and resource were up for grabs after the war, and all these lands required investment to be turned into productive farmland. It was the lending of the private banks, the money printing, that enabled this. Economic growth was restarted in 1823 when the Second Bank of the United States once again began lending to the smaller private banks. Controls were introduced to slow the bubble, such as reserve requirements that were frequently checked under the authority of Nicholas Biddle, the new president of the Second Bank. Between 1830 and 1836, the number of banks doubled. In 1836, President Andrew Jackson blocked the rechartering of the Second Bank of the United States, and easy money was back on the menu. 70 years of boom and bust cycles occurred from largely unregulated banking practices. When a bank run occurred, the banks would collapse, and the financiers that financed it would lose money. Major panics and bank runs happened a further 5 times until 1900. But investors kept coming back for more. The profit from making loans to unlock the rapidly expanding wealth of the frontier was simply too great. Similarly, the rapid growth of industry and agriculture in the West would have been impossible without such laissez-faire and free spending. The West was built on dodgy banks and easy loans. Next, we move on to the Civil War of 1861. The war wasn't cheap, and the Union had to pay for both its own army and the reconstruction of the South thereafter. The war cost $1.5 billion, 66% of which was raised by borrowing, 21% by the new temporary income tax, and 13% through inflation. Ultimately, some $450 million of the new greenbacks were printed to cover these costs. But the government was able to repay these greenbacks with the newfound economic prosperity that came from the rapid economic expansion they enabled. As they began to repay and retire the greenbacks at $10 million a month, a new problem emerged. The monetary supply was contracting heavily. Farm mortgage debt had increased during the war, and with the deflation it became increasingly difficult for the farmers to repay it. The farmers let their congressmen know how the contraction of greenbacks was hurting their livelihoods, and in 1874 it was voted that the greenbacks would continue to circulate permanently at a level of $400 million. After the Civil War, the monetary history was described by contemporaries as deplorable. Without a central bank to issue a single currency, a chaotic mixture of currency existed, including greenbacks, private banknotes, and many different coins of domestic and foreign origin. In 1908, Andrew Carnegie, that of steel magnate fame, described the financial system of the United States as the worst in the world. However, this was not the only side to the story. Those who spoke despairingly of the monetary aberrations of the United States in the last century couldn't help but mention the phenomenal but somewhat contradictory economic growth which accompanied such a wretched monetary policy. Such a combination had never been seen before. So far, I have not mentioned the appearances that gold and silver coins, and notes redeemable in these species, made from the late 1790s through to the 20th century. A double standard for money existed during this time in the States. The rapidly expanding western frontiers wanted easy paper money for economic growth, and the bankers in the more developed East wanted hard currency that would protect their fortunes. In response to this, a great compromise was met that somewhat isolated the paper financial affairs of the West from the hard currency of the East. Therefore, the 6 or so panics of the 1800s were mostly isolated affairs restricted to the town or state in which they occurred. That said, the profits of frontier lending still attracted investment from the East, although it was known to be higher risk. I want to touch briefly on the role of paper money in the Russian Revolution. In 1913, Russian government debt under the Tsar was the largest in the world. In the final years of the war, the revolution occurred, and the Soviets defaulted on all foreign debt. It was the largest default in history, and the French, English, and other creditors lost billions in loans, to their great protest, and printed currency backed by nothing other than the monopoly on currency that the government enforced. This, of course, led to hyperinflation, but just like in France, the revolution had been financed. Money printing also featured heavily in funding the reconstruction of France after World War I, and in the reconstruction of Germany, Japan, and other countries ravaged by the Second World War. The way in which it occurred was more or less the same as America had paid for their 3 domestic wars. A limited amount of currency was printed, and this was used to stimulate reconstruction and facilitate commerce. The Weimar Republic of post-World War I Germany, and also the Republic of Austria, experienced hyperinflation between 1921 and 1923 due to excessive printing and expectations of reparations. Indeed, it was largely the latter, these expectations of reparations, which did not fully occur anyway, that led to the hyperinflation. With the public believing $33 billion of World War I reparations were soon to be paid to France and others, money was soon to be printed in excess and fall in value. And this expectation is what caused everyone to rush out to purchase goods and other assets. This caused a strong rise in the price of everyday goods. With the Depression, collapse of Germany's economy in 1931 occurred. Less than $6 billion was eventually paid. To stop the hyperinflation, the Rentenmark was introduced in 1923 with success. But with no gold in the country after the war, the Rentenmark was backed by land purchased with it, used for agriculture and industry. The Rentenmark was replaced by the gold-backed Reichsmark in 1924, in turn replaced by the Deutschmark, which facilitated the post-World War II German financial miracle in 1948 onwards, known as the Wirtschaftswunder, or Miracle of the Rhine. So the question remains, does money printing, and rather inflation, impoverish the poor? In some cases. This is a difficult question to answer, and depends heavily on the nature of the country or region in which it is being introduced. In the cases of the economic development of the American Western frontier, it undoubtedly worked to foster budding industry and agriculture. Inflation raises the cost of living. It raises the values of wheat and other essential commodities. When the global economy was based largely on our agriculture, this was less adverse than it seemed. Wheat would cost more, but farmers and workers would benefit from increased cash from the sales of this wheat that they could reinvest in farming goods. On the other hand, it hurts laborers and those paid in wages. As less and less people in the West produce commodities for their income and switch over to set wages, this is starting to cause financial burden. But this burden is being shouldered by the majority of the public, who have grown rich relative to their ancestors a century earlier. Times have never been better, and the fat of these times is being increasingly skimmed off by inflation. Paper money is undoubtedly a good thing, and essential for struggling economies, but that is only if it is being invested into productive assets that produce wealth, such as farms, business, and industry. In the past 6 years, we have seen the monetary supply of the US dollar skyrocket. The question remains, why are we not experiencing crippling inflation right now as a result? There are 2 reasons. The first is that increasingly large supply chains and technological advance have lowered the cost of manufacture of almost all goods, except those of luxury. We can see this reflected in the skyrocketing prices of collectible cars, artwork, and other such assets. Second is the monetary velocity. Most money being spent is ending up in deposits or investment funds of large corporations. These funds largely act as dams, where money is stored and does not enter circulation and raise prices of common goods. Problems will occur, however, if these dams are discharged. And before you suggest it, gold or silver standards are not the magical cure-all some make them out to be. They are certainly inadequate in times of war, when gold and silver rapidly disappears to buy commodities of war, leaving a country impoverished and unable to recover or rebuild. They are also inadequate in times of rapid economic growth, as in cases of developing countries and regions such as the American frontiers of the 1800s, post-World War II Japan and Germany, where lending was crucially needed. It is true that gold and silver standards can function well outside of times of war and economic distress, such as when Europe and the US voted to join a gold standard in 1867, which provided a reliable currency and low inflation until World War I. But it could not hope to pay for post-war reconstruction, and was abandoned by all except the United States, the country least affected by the war. So in concluding, I'm going to end this here. As this list of money printing and its consequences over the last 400 years show, having a central bank and paper currency is not such a bad thing for enabling commerce and economic growth. It is only when the central banks fail to control lending in an effort to sustain bubbles, such as they have been doing in the world over since 2008, that we run into trouble. That trouble is further amplified by funneling money into unproductive assets, such as shares and property. The problem lies not with the mechanisms of banking and money printing, but rather with those that control them, and the general indifference and ignorance shown by a fat and comfortable populace in governmental economic policy. Our fathers 100 years ago knew far more about banking than the average man does today, and that is something that must change before we can depart from our path of destruction that current money printing is lending us towards. Thank you for listening.